Money Vikings, welcome back. Thank you for joining me. I think you'll find this to be one of my most critical videos in terms of information. I'm titling it How to Get Rich with Risk. And I'm going to base this on a very important video series that has started, and you can see it off to the side here from Oak Tree Capital from Howard Marks, who's a well-respected investor that I like to listen to and read about quite a bit. But I'm also going to present 6 ideas in terms of thinking about risk and applying it. As you know, I like to apply things in a very practical, straightforward way. I don't like overly complicated things or overly complicated strategies because I just don't. I'm not drawn to that. And I think given the nature of life and the nature of investing in reality, when things are overcomplicated and there's overcomplicated plans in terms of investing, I think it typically leads to folly and it leads to less returns and less wealth building. So I just want you to keep in mind that you should probably listen to this. If you can't watch the whole thing, I would put it on in the background and listen to some of the excerpts from Howard Marks, and then you can hear out my 6 ideas in terms of how I'm applying the kind of things he's saying about risk in my own true wealth journey. And what I think is really critical about this is that it goes against what is common, sort of, not common knowledge, but what is sort of common misperception or misconception. And I'll give you a quick example of that. So there's a typical saying out there, the more risk, the more reward. Well, that's actually simply just not true. And it's one of the reasons that we talk a lot about portfolio construction and how important that is in terms of wealth building and building resilient, strong, diversified. I call it strategically diversified. When you're strategically diversified, you're not just randomly buying a little bit of everything. You're being thoughtful and you're looking at the world from a holistic point of view. You're thinking about macro trends in terms of demographics, supply and demand trends, technology trends, and you're making strategic moves. Now, I use ETFs and funds. I try to stay away from the individual stocks for the majority portfolio, try to reserve that kind of stuff for maybe 5-10%. But I like to strategically diversify within ETFs across different assets. So I want to talk about that. So let me first start by playing a little bit of what Mr. Marks says. And then throughout this, I will share my 6 ideas in terms of how to basically get rich with risk and how to think about risk to become a better investor and to build wealth. Let's play a little bit.
I'm Howard Marks, and this is how to think about risk.
And I'm going to...
The title of this class is How to Think About Risk. That's an important title. Not what to think, how to think. The first question is, what is risk? Risk, in my opinion, is the ultimate test of an investor's skill. The return alone doesn't tell you how good a job the manager did. The key question is, you see the return, you must ask, how much risk did the manager bear to get that return? Now let's look at this range of managers. What we posit.
So I'm going to get right to this point here. What he talks about here is 5 different managers, and one of them basically just goes with the market. If the market's up, he's up or she's up. If the market's down, they're down, right? One of them makes very little money when the market is going up, but doesn't go down very much at all, like a savings account or CDs, right? One of them basically makes a ton of money when things are all going up and going great, and then loses a ton when everything's going down. So it's like always on this very aggressive risk treadmill. But then there's another one where they make a little more when the market's going up and things are going well, and then when everything starts going down, they mitigate, right? They do go down, but they were able to mitigate. So if everything drops 20%, they're down 10% because they were strategic in how they were building the portfolio. So I'm just going to get right to that, and then I'm going to go into some other stuff here. He talks about, is risk quantifiable? So he really likes to stray away from the concept of making everything about numbers. He talks a lot about sometimes you have to just use your brain and look at things holistically, and you can't necessarily just put a number on everything. Okay, we'll watch a little bit more.
I believe that risk is not volatility. The academics developing investment theory, largely at the University of Chicago in the early 60s, just a couple of years before I got there, adopted a risk premium in terms of the return. This is risk, the possibility of loss. Now, another important question is risk...
So let me talk about that. When people think about risk in investing, they typically have a lot of fear around this, right? And we talk about how fear is so dangerous in terms of investing. It can be dangerous in life, but it can also be helpful, right? It creates guardrails and it makes us think about the world and the actions we're going to take. There's certain things like smoking and using drugs and all those things that are more risky or create more risk in our lives. But he gets to the point here of, is risk quantifiable in advance? And he basically says it's not. And the other key factor here and the key thing that he talks about is that, yes, there's risk in the world, but it doesn't mean those things always happen. They happen sometimes. And when they do, you can't really prepare. You can build a portfolio that is resilient and is thoughtful, but when the risk event happens, it's going to happen. And there's really nothing you can do about it.
Quantifiable in advance. And I believe it's not. Like most things occurring in the future, risk cannot be anything except a matter of opinion. I was writing my first memo about risk in 2006. I wrote about my belief that risk is not quantifiable in advance. And then I hit the return key and went on to the next section and wrote something I had never thought about before. My belief that risk is unquantifiable even after the fact. And I think this is a fascinating topic. You buy something for $1, and a year later, you sell it for $2. Was it risky? And the interesting thing is that you can't tell from the outcome. A profitable investment may or may not have been risky. Was it a safe investment that, in the case of my example, was sure to double? Or was it a risky investment where you got lucky?
So let me make a couple comments here. One thing we've talked about a lot at Money Vikings is that sometimes doing nothing is risky. So we all know about inflation now, especially over the last couple of years. And if someone was saving their money and not being risky and put it in a savings account, they've done awful by being risk averse and by being scared because their savings account has lost value every single year. So it's just, you have to be thinking about risk in a more dynamic way. Sometimes being risk averse is the most risky thing.
In terms of the outcome. And as I say, you can't tell from the outcome and may never get back on. I had a high and you experience a decline. If you're able to hold throughout and not lose your nerve, the next high is usually higher than the last high.
Let's park on that for a minute because it's going to go into my 6 concepts of using risk to get rich. I have seen time and again when people have freaked out when the market drops and they've sold everything. That's actually the worst thing to do. And we have to think ahead and prepare ourselves for those moments. So it's going to happen again. The market's going to drop again. A week and a half ago, we went through it again. And guess what? The market went right back up. So a week and a half ago, someone could have said the sky's falling, it's all over, there's never a company that's going to make any profit ever again, everything's overvalued, it's all going to zero. Well, it went down and then it went back up. Not to say it won't go down again, it might. But again, you have to keep in mind as an investor, and that's why a lot of times, sometimes the most successful people aren't even paying attention to this. They're just dollar cost averaging every 2 weeks into a diversified fund. There's nothing wrong with this. A low-cost, diversified S&P 500 index fund, maybe 20-30% in bonds, maybe 10% in small caps, maybe 10 to 20% in foreign, diversified investments. And guess what? Over the long run, they're not going to pay attention to the dips. They're going to buy more shares. It's going to go up again, dip, buy more shares. It's going to go up again. 35 years later, they're going to have a great nest egg and they're going to have a great retirement and go on a cruise.
Fact that you experienced a downward fluctuation might have been uncomfortable for a little while, but by the time the new high is achieved, you're back to your cost and more. But if you sit, so now let me try in a slightly philosophical sense to reflect to you how I think about risk, how I think you might consider risk, through 4 basic points. Number 1. There was a professor at the London Business School who said, risk means more things can happen than will happen. For most events that lie in the future, there are a number of things that could occur. We don't know which one it will be. That's where the risk comes in, distribution.
So to me, this is a psychological game. And we all know that everything about life has risk. The minute we get in our car and go drive out, the minute we walk out our door, being in our house has risk. So it's just, you have to realize it's the nature of life. So that's why sometimes the riskiest thing is doing nothing and being afraid. But on the other end of that, there's being absolutely reckless and putting everything in some really risky, high volatility, fly by the night, penny stock that we think is the next big thing. That's highly risky too. So I'm always trying to find that happy balance between things. And that's why we built, and you can check it out at truewealth.moneyvikings.com. That's why we built things like the Ride My Bike portfolio. I love the Ray Dalio all-weather portfolio. I really am fascinated by portfolio construction because I think that is the key to long-term success. And I'll get into that.
It looks like we know what's the most likely, the other likely possibilities, and the unlikely possibilities. We still don't know what's going to happen. So knowing the probabilities does not eliminate the uncertainty.
So he likes to talk about things in terms of a bell curve. And most of the time, everything's going to be in the middle. But there's, of course, the outliers that are part of life.
And to do riskier things. And that's why I believe that risk is low when investors behave prudently and high when they don't. Just as risk is counterintuitive, I believe that risk is perverse. As I said, the riskiest thing in the world is the belief that there's no risk. A high level of risk consciousness, on the other hand, tends to mitigate risk. So when people say, well, that's really risky, if they take a cautious approach, then it becomes safe. As an asset declines in price, most people say, oh, it's risky, look how it's falling. But with the lower price, it actually becomes less risky. As an asset appreciates, most people say, that's a great asset, look how well it's doing. But the rising price makes it riskier.
So Howard Marks is known for taking bets on things that went down in value and got crushed by the market or crushed by sentiment. And so at that point, he would see it as less risky. He's buying an asset very cheap. It's kind of like Warren Buffett does, right? Where they're buying things at a good price and that lowers their risk. So with that, you can watch the thing yourself. It's at Oaktree. Look up Howard Marks. You can watch the whole thing or listen to it. I think it's worth it. Let me get into my 6 takeaways from this entire talk and how I would manage risk to get wealthy. Number 1 is building sound, diversified portfolios. So really think about the portfolio construction. Again, if the S&P 500 seems really high and you've got your whole portfolio in that, when it crashes, you're going to ride that down. It's going to go down a lot. You'll probably be fine in the long run, but the key is you got to know in advance that might happen and not sell everything at the bottom if you've bought it really high. That's where the problem comes in. The problem doesn't come in if you hold on and ride it out. Okay. Number 2, the second thing I took from this: risk is a fact of life. It's a fact of investing, and we just need to have it as part of our consciousness and as part of our awareness. We shouldn't be frozen from risk, but we should think about risk management as we are constructing our portfolio. And that's why I like to talk a lot about knowing yourself and knowing how you would react and training yourself to react in a certain way when the market has volatility or goes down, which it will occasionally. The third thing, which ties into this, don't sell low if you built a sound portfolio. Let it ride, let it continue. I'm not saying don't get rid of dogs or get rid of investments that are just sour and seem to have no future. But if the market is just being irrational and the portfolio is sound, it will probably go back up, most likely. Okay. The fourth thing I want to talk about is we cannot have, this is just about life. We should not be mired in regrets in life, really about anything, because none of us has a crystal ball. We can't assess everything that's going to happen and base our life on that. There's times when we have to make decisions. We have to clearly make decisions day to day. We have to make all kinds of decisions about our career and our family and our investing and our money and our budgets and where to go and what to do. And we just have to make the best informed decisions that we can at the time. It does very little good to look back and say, well, I regret and I should have, I could have. You probably did the best you could at the moment. So give yourself a little bit of slack and realize you have now and the future. That's why I think the power of Money Vikings comes in. We are providing so much information and inspiration in order to make the best of right now. Okay. The fifth thing I want to talk about, focus on what you can manage and control when it comes to risk. Okay. Let's think about it this way. You control, so your paycheck comes in and you control deciding how much to spend on your rent and your mortgage. You control what kind of car to buy. You control whether to spend money on things that are not going to mean anything to you and are frivolous, right? You can control that kind of stuff to a certain extent. So think about the things in terms of your wealth building that you have control over. I like to get the big things right. You get the big stuff right. You don't have to worry about the little stuff as much. But think about the stuff you control. Then there's the things that you influence, and there's stuff totally out of your control. None of us has control over the stock market. None of us. We're going off of assumptions that that we have 100 years of data. It typically will go down and then it goes back up, goes down, goes back up. We know that recessions and business cycles happen. We know that humanity will continue to try to live and consume and live our lives. That's what it's all about. Everyone's eating and buying and building families and building things and homes and driving cars and whatever it is. So, you can make assumptions about that. We're going to need medicine. We're going to need medical care, all that kind of stuff. So the economy is going to continue to hum on because it hums on. It's part of humanity. It's part of the things we're doing, right? And the sixth, I guess, idea I would think about is be careful with very expensive advisors. They're probably not, if you're paying a lot to a financial advisor, they're probably not going to be able to do such great things for you that you can't learn how to do on your own in terms of building a good portfolio. And basically, again, having some of the growth during the good times and then mitigating the downside a little bit. And what that means by mitigating the downside is that it means having exposure to diversified assets that maybe are uncorrelated. And it also means not having all your eggs in one basket. These are simple ideas that most people understand, right? So those are my 6 big ones in terms of using risk to get rich. We'll watch a little more of Howard Marks before we go, and I'll end with a couple of quotes from here.
So again, risk is not a function of asset quality. This too sounds counterintuitive. There's a belief that high quality assets are safe and low quality assets are risky. I believe quite the opposite. A high quality asset can be priced so high, then it's risky.
Yeah. Okay. I'm going to end with this quote from this video, which I thought was very powerful. It said, assembling a portfolio that incorporates risk control along with the potential for gains is a great accomplishment. I'm going to read it again because I think this is the heart of the matter. You're trying to assemble a portfolio that incorporates risk control along with the potential for gains is a great accomplishment. That's exactly what our Ride the Bike portfolio is trying to do. It's trying to be a portfolio that grabs some of the growth as it continues, but when things tank, it has a little bit of a buffer to keep it from going way down and everybody freaking out. So that's it. Hey, those are some ideas, guys. What are your ways of managing risk when building wealth and in life in general? How is your thinking go in this area? I think it's interesting to check it all out. And a guy that doesn't have to worry about risk too much is, of course, Deadpool. I got my Deadpool shirt on for you guys today. Hey, thanks a lot for watching. Please like, subscribe, share all that great stuff. See you next time. Bye.